With respect to the global economy, we've been through a period in which there's been a substantial appreciation of the dollar, and that depressed for quite some time import prices. But that trend has now come to an end, and import prices are rising at a modest rate. So I don't see the global economy as, at this point, mainly responsible for the low inflation readings. You know, as I indicated in the quote that you mentioned, I do think there is some special one-time transitory factors, these unusual changes reflecting the move to unlimited data plans for cell phones and large declines in some prescription drug prices. There may be more going on, and we're watching inflation very carefully in light of low readings. I think it's premature to conclude that the underlying inflation trend is falling well short of 2%. I haven't reached such a conclusion. We are watching data very carefully, and I would say I regard the risk as being two-sided with respect to inflation. On the one hand, we are seeing low inflation numbers for several months. On the other hand, we have quite a tight labor market, and it continues to strengthen. And experience suggests that ultimately, although with a lag, we're not seeing very substantial upward pressure on wages, but we may begin to see pressures on wages and prices as slack in the economy diminishes. So I see the risk with respect to inflation as being two-sided, and with respect to how that bears on policy, most of my colleagues and I, when we looked at this matter in June, even recognizing that we've had several months of low inflation readings and that we're focused on trying to understand it, have felt that it probably remains prudent to continue on a gradual path of rate increases. But it's something we will watch very carefully, and I want to emphasize that monetary policy is not something that's set in stone, and if our evaluation changes with respect to inflation, that will make a difference.